Welcome to Breaking News to Trading Moves.
Our mission today is pretty straightforward. We're going to focus on a core piece of financial news, a record outflow from a flagship investment product, and from there we'll analyze the resulting winners and losers.
And we're going to do that based purely on the reported market flow data. The goal here is to give you a clear understanding of what happened and what it tells us about asset rotation.
Exactly.
The headline we're looking at details a record cash exodus from BlackRock's iShares Bitcoin Trust, which is known by the ticker IBIT.
Right, IBET.
We're going to explore the asset movements that followed this event, looking at where that capital decided to go next.
Okay, so let's start with the specifics of the event itself. This wasn't just any outflow.
No, not at all. We are talking about a record outflow from the iShares Bitcoin Trust, IBIT.
Here.
This really felt like a market event in and of itself, just based on the sheer size of the cash withdrawal.
And the magnitude is, well, it's something. Investors pulled approximately $523 million from the trust.
In a single day.
In one single day. This is the biggest withdrawal that ETF has seen since it launched.
And to put that into perspective, IBIT, along with the other spot Bitcoin ETFs, was initially praised for its ability to attract consistent institutional interest.
Absolutely. For months, it was seen as this product that signaled the maturing of the digital asset class.
So a sudden retraction of over $500 million that really stands out. It's not just a data point. It feels like a reversal of that positive momentum.
It is. A single-day move like that often points to a coordinated, or at least a highly correlated decision among a group of very large holders to de-risk and to do it immediately.
It's an exodus. It cuts right against the narrative of consistent accumulation that we'd all gotten used to.
It does. And you have to look at the market environment this happened in. This wasn't in a vacuum.
Right. This record redemption happened while Bitcoin's price was dropping, reaching what's being described as a 7-month low.
A 7-month low. And this follows a period where Bitcoin had hit record highs back in October. So we're seeing a sharp reversal.
We saw Bitcoin ride this wave of enthusiasm, driven in large part by the anticipation of these very ETFs getting approved.
Right. That whole run-up culminated in a record valuation just a few months prior.
And now, it looks like we've entered a cooling-off phase marked by, well, investor apprehension. The drop to a 7-month low suggests a considerable portion of those recent gains has been erased.
It does, and it leads many to reassess their short-term positioning. It signals that this event is a function of both the fund's performance and the overall market fear.
It's a double whammy for IBIT holders.
It is. And if we interpret the movement, this activity really highlights a broader pullback from some of the more volatile, speculative assets across the market.
So when investors choose to liquidate such a substantial position in an asset like Bitcoin, especially through a liquid, regulated product like IBIT, what does that tell you?
It often signals a collective reevaluation of market risk. It implies that these investors, who are generally sophisticated, have decided that the current environment no longer justifies the volatility premium that's associated with Bitcoin.
And the resulting asset movement points to a tactical rotation of capital.
The common playbook in this scenario is to move into assets that are widely viewed as safer havens. The sheer volume of this IBIT outflow makes it a powerful data point for gauging sentiment and confirming a move into a more risk-off mode.
Okay, so that clarifies the headline event. $523 million rushes out of a flagship crypto product. So the big question is, where did it go?
Right. As money leaves one area, it has to flow into others.
And we've identified 3 categories that seem to have benefited from this capital movement, starting with, well, the most conventional safe haven asset.
The first one is a rotation into gold and other safe haven ETFs. Think GLD and IAU.
Right. The rationale for gold seems pretty clear here. As Bitcoin saw a sell-off and IBIT experienced these record redemptions, the data indicates that some investors moved capital directly into gold products.
It suggests an almost immediate textbook reaction to volatility in the digital asset space. Investors are seeking the stability of a traditional store of value after being exposed to a rapid price decline in Bitcoin.
And this is where that narrative collision happens, isn't it? For years, Bitcoin was marketed as digital gold.
It was a hedge against central bank policy, against inflation, something capable of replacing the metal.
But when real market stress hits, we see a palpable transfer of capital from a digital gold product back to physical gold ETFs. That tells you a lot about which asset truly retains institutional trust when things get choppy.
It really does. Gold has demonstrated relative resilience during this period. It maintains its position as a classic asset to hedge risk in markets that are perceived as risk-off.
And we're talking about specific products here, like the gold ETF, ticker GLD.
Correct, GLD. And also the iShares Gold Trust, ticker IAU. IAU. These continue to be the default choice when emerging volatile asset classes face severe pressure.
Why is that?
Well, gold's lack of correlation to many risk-on assets makes it a reliable anchor for institutional portfolios during periods of liquidation or sustained market weakness.
And if you think about the operational aspects for a large fund that's exiting IBIT, moving that capital into GLD or IAU is logistically simple.
Extremely simple. These are highly liquid, widely accepted instruments. The institutional preference for these widely understood gold ETFs makes them a primary, immediate beneficiary when large volumes of capital are looking for a safe harbor.
Let's talk a little more about the logistics of that asset rotation, because the speed of the transition is really key here.
It is.
When an institution liquidates a major position in IBIT, they suddenly have $500 million sitting as cash on their balance sheet. They need to redeploy it, and quickly, to meet their portfolio mandate.
That's a crucial point. The move from IBIT to GLD or IAU isn't sentimental, it's mechanistic. Both GLD and IAU are among the largest commodity ETFs in the world.
Their daily trading volume and their assets under management, their AUM, just dwarfs most other products, including these newer Bitcoin ETFs.
Exactly. And that allows institutional traders to absorb hundreds of millions in inflows without, unduly moving the price. It ensures an efficient execution.
Plus, gold as an asset satisfies a lot of regulatory and internal compliance requirements for safe asset allocation in a way that Bitcoin, well, it still struggles to do that globally.
So for a portfolio manager in a defensive posture, moving into GLD or IAU is the path of least resistance and greatest stability. The inflow into these specific tickers is a direct, measurable indicator of capital seeking established safety.
Okay, so we see the passive flight to safety. But money flows aren't always just about hiding. Sometimes they're about active positioning.
That's a great distinction.
I want to move now from that passive safety net of gold to the truly tactical decision makers.
And that brings us to our second category of winners, inverse or short Bitcoin products. Think of the ticker BITI.
And moving beyond traditional hedges, we're looking at products designed to capitalize on downside price movement.
This is a crucial distinction. Investors aren't just trying to avoid losses. They are actively positioning for gains based on a continued decline in Bitcoin's price.
Which suggests a real level of conviction. If I move to gold, I'm basically saying, I don't know what's next, so I'm waiting it out safely.
Right.
But if I'm moving to a short product, I'm saying, I believe the pain isn't over and I want to profit from it.
Precisely. And the products we're talking about here include the ProShares Short Bitcoin Strategy ETF, ticker BITI, and other similar U.S.-listed ETFs that are structured to move inversely to Bitcoin's price.
So they're designed to deliver the opposite return of Bitcoin. They gain value when Bitcoin loses value.
Correct. They offer a simple, regulated way for investors to express a bearish view or to hedge their existing long exposure, all within a traditional brokerage account. No need for complex derivatives or margin accounts.
Let's explain the underlying mechanics for a moment, because this isn't a product that holds physical short positions in Bitcoin. How does an ETF like BTI actually achieve that inverse exposure?
That's vital to understand the tactical nature and the risks. BTI does not hold physical Bitcoin. Instead, it gets its inverse exposure primarily by trading Bitcoin futures contracts.
Specifically the ones on the Chicago Mercantile Exchange, the CME.
That's the one. To get an inverse return, the fund manager essentially sells futures contracts short. As the price of Bitcoin goes down, the value of those short futures positions goes up, which provides a positive return to the ETF.
Now, that mechanism has a very specific cost and risk profile that an investor moving, say, a portion of that $500 million out of IBIT has to be keenly aware of. I'm thinking of roll yield or contango.
Absolutely. This is the technical nuance of using these futures-based products.
Yeah.
In a market scenario called contango, where the futures price is consistently higher than the expected spot price.
The ETF faces a steady headwind. It has to roll its short position from an expiring contract into a new, more expensive one.
Correct. And this constant drag, known as negative roll yield, means that unless Bitcoin drops sharply and quickly, the fund's performance can actually suffer, even if Bitcoin is just flat.
So the fact that capital is flowing into BT despite this structural drag, that indicates a high conviction that the downward momentum in Bitcoin is strong enough to overcome those costs.
Exactly. The rationale is if the pressure on Bitcoin continues, these products will benefit. Using these inverse products implies a belief that the recent outflow from IBIT isn't just a one-time adjustment.
But maybe the start of a more prolonged period of weakness.
Right. Investors rotating here are explicitly betting against a near-term recovery. They're using the negative sentiment to their advantage by deploying capital into products structured for exactly this outcome.
The flow into an inverse product like BTI is just a textbook tactical play.
It is. When such a massive sum exits IBIT, some portion of that money finds its way to BITI because those investors believe the negative momentum is accelerating. It democratizes the ability to bet against an asset class via a regulated product,
Which just enhances the overall velocity of asset rotation in response to negative news.
It's a move by sophisticated players who see the volatility as a feature, not a bug, and they're prepared to pay the structural costs of the ETF for that tactical gain.
Okay, now this next winner is the most counterintuitive one. And for me, it's the most fascinating detail in this whole flow analysis.
I agree.
If investors are fleeing risk, why on earth are they moving to an asset like Solana, ticker BSOL, which is inherently higher risk and more volatile than Bitcoin?
It counters the simple narrative that all capital is fleeing digital assets entirely.
It does. It shows there's an important nuance here. Not all crypto exposure was abandoned. There's evidence of rotation within the broader crypto asset class.
And that's what the flow data shows. While the core spot Bitcoin ETFs were losing assets, certain alternative coin ETFs continue to attract fresh inflows.
This observation is so crucial because it suggests selectivity among investors. They're not treating the digital asset market as just one single thing.
No, they're distinguishing between the performance and prospects of Bitcoin versus other specialized digital assets. The fact that capital is moving into other crypto-related products rather than just exiting the ecosystem demands a closer look at the motivations.
Right. The rationale here seems to be that investors weren't exiting the crypto market entirely, but they were rotating capital to different areas within it.
Potentially searching for higher growth potential or maybe improved yield characteristics.
I see this as a classic alpha-seeking maneuver. When the largest, most established asset in a category, in this case, Bitcoin, is underperforming, investors seeking outperformance often look further down the market cap spectrum.
And in that territory, volatility is higher, but potential percentage gains might also be greater in a recovery.
So it's a risk-on maneuver within a restricted asset class. You're trading established stability for potential acceleration.
And let's talk about the specific technological narratives driving this choice, focusing on products like the US-listed Solana ETF, BSOL, and others like GSO.
Okay.
Bitcoin's primary value proposition is security and decentralization as a store of value. Solana, the asset underlying BSOL, has a fundamentally different narrative. It's all about high transaction speed, low transaction costs, scalability.
It's designed to be a platform.
Exactly. A platform for decentralized applications and high-volume trading.
So when IBIT is hemorrhaging capital because investors are questioning the digital gold thesis, the capital that stays in the ecosystem moves to products that offer a growth story that's independent of that store of value narrative.
That's it. The rotation to BSOL and GSL suggests a deliberate attempt to maintain exposure to the digital asset market while recalibrating the risk-reward profile toward assets that are perceived to have more favorable short-term catalysts.
Catalysts rooted in utility and technological adoption.
Right. For an institutional investor, that $500 million outflow from IBIT isn't just one trade. It's multiple portfolio decisions. Some go ultra-safe to gold, some go tactical short with the BITI.
And others make a selective internal reallocation.
Essentially saying, if I'm going to take crypto risk, I want the highest growth beta I can find. And right now, products tracking the Solana ecosystem fit that profile perfectly.
The granularity of this movement is crucial. It's a very specific flight within the crypto asset class. It's not just any altcoin getting the money.
No, it's the ones associated with high-speed smart contract platforms. This is the market distinguishing between Protocol 1.0 Bitcoin as value and Protocol 2.0 Solana as utility.
And that distinction is driven by performance metrics beyond just price.
Yes. Solana's ecosystem activity, measured by things like daily active users, total value locked in decentralized finance, low transaction fees, these provide tangible metrics of usage and growth.
So when Bitcoin stalls, institutional funds can point to these operational metrics in Solana as a justification for keeping capital in the digital asset space, just reallocate it.
Exactly. This rotation into BSOL is not a traditional risk-off move. It's a sophisticated, relative value trade betting on the continued adoption of smart contract technology.
That wraps up the winners then. We've covered passive safety, aggressive tactical shorting, and selective internal growth rotation.
Right.
Now we need to turn our attention to the specific names and sectors that face pressure because of the record outflows and the decline in Bitcoin's price.
Understanding the winners is only half the story. We have to analyze who bore the immediate consequences of this market adjustment.
First up, the most obvious losers: the spot Bitcoin ETFs themselves and the pure BTC funds.
These funds absolutely bore the brunt of the negative sentiment directly. The group includes IBIT, which we know saw the record withdrawal, but also GBTC, the Grayscale Bitcoin Trust, and FBTC, the Fidelity-Wise Origin Bitcoin Trust.
The entire ecosystem of spot Bitcoin ETFs is deeply intertwined, isn't it?
Very much so. While one fund, IBIT, experienced the largest redemption, the overall market sentiment affects all competing products. The fact that capital is exiting the most liquid, newly launched, and institutionally backed products indicates a widespread, temporary lack of conviction.
A lack of conviction in the thesis that spot ETFs alone would ensure price stability.
Right, and then you have the financial consequences.
Which are?
Well, weaker sentiment diminishes that narrative of Bitcoin as a reliable digital gold hedge. The observable result is lower assets under management, or AUM, and heightened pressure on fees across all the spot BTC ETF offerings.
That's a crucial negative feedback loop for the issuers.
It is absolutely critical. The digital gold thesis relies on Bitcoin maintaining its value during broader financial instability. When a large outflow like this happens at the same time as a price drop, it casts doubt on Bitcoin's role as a portfolio stabilizer.
Especially when physical gold, through GLD and IAU, is simultaneously seeing inflows.
That direct competition severely impacts AUM, which is the lifeblood of an ETF issuer. ETF revenue is calculated as a percentage of AUM. When a fund loses $523 million, the issuer instantly loses the future management fees on that capital.
And as AUM shrinks or stagnates across the whole sector, the competition among the issuers has to intensify. We've seen this playbook before in traditional ETF spaces.
The inevitable result is downward pressure on management fees as funds try to attract or retain their remaining investor base.
That's the secondary pressure point.
Exactly. The Grayscale Bitcoin Trust, ticker GBTC, for example, already carries a higher fee structure because of its history as a closed-end trust that converted into an ETF.
So any broad negative flow pressure just makes it harder for GBTC to justify its fee structure compared to IBIT and FBTC.
It does. IBIT and FBTC launched with aggressive low-fee models. Similarly, Fidelity's product, ticker FBTC, faces the same challenge, maintaining scale and attracting new capital when the leading product in the space is hemorrhaging assets.
They all get embroiled in a fee war that's dictated by a shrinking pool of available capital.
IBIT's outflow creates a negative benchmark for the entire product category. It forces all issuers to potentially reconsider their long-term pricing strategy just to remain competitive.
So this single outflow event forces a painful self-reflection for the entire ETF complex, which is really built on the premise of perpetual institutional inflows. When the faucet turns off, or reverses,
the structural weakness of relying on a high fee model for scale becomes painfully obvious.
Okay, let's move to the second sector affected. This involved the platforms that facilitate crypto trading. We're talking about Coinbase, ticker Coinine, and Robinhood Markets, ticker HOOD.
Right. These companies are the essential infrastructure for digital asset transactions. That makes them exquisitely sensitive to any changes in trading enthusiasm.
And the consequences for their revenue are pretty direct. When major ETFs see outflows and asset prices drop, both retail and institutional trading activity tend to slow down.
Lower trading volumes and a reduction in speculative trading appetite generally lead to softer transaction revenue and more cautious forward guidance from these publicly listed platforms.
Let's take Coinbase, ticker COIN. It earns a substantial portion of its revenue directly from transaction fees.
It does. A $523 million outflow from IBIT signals institutional caution. And that fear often bleeds immediately into the retail investor community.
It's a cascading effect. The institutional investor exiting IBIT isn't trading on Coinbase, but their exit confirms a negative market environment.
And that negative confirmation then leads to retail paralysis. A reduction in retail activity translates very quickly into diminished transaction volume, which directly hits the top-line revenue for exchanges like Coin.
We often see their management adjust expectations downward almost immediately following market-wide volatility events like this one.
And Robinhood Markets, ticker HOED, faces similar, though maybe slightly different, exposure.
While they're known for broader brokerage offerings, a lot of their recent growth was fueled by enthusiasm for commission-free crypto trading.
Exactly. Hood thrives on high-frequency, speculative retail engagement. When the broader market cools, and especially when confidence in leading assets like Bitcoin is shaken, that speculative retail engagement tends to dissipate.
They see fewer active users logging in to make those quick, frequent trades.
The flow data really makes a strong case for linking these ETF outflows to exchange performance. The ETFs are designed to absorb institutional flow, and when that flow reverses, the broader market typically sees reduced retail interest shortly thereafter.
Exchanges are the ultimate reflection of market engagement. A reduction in speculative trading is their primary operational risk.
In essence, IBIT's outflow suggests institutional fear, which often precedes broader retail apathy and trading slowdowns. That puts direct pressure on Coin and Hood's quarterly revenue models. The market isn't just worried about Bitcoin's price, it's worried about the health of the entire transactional pipeline that they operate.
Okay, that brings us to the final group of losers.
This group consists of companies whose business models or balance sheets are closely tied to Bitcoin's value. Think MicroStrategy, ticker MSTR, Marathon Digital, ticker MARA, and Riot Platforms, ticker RIOT.
These are often called proxies for Bitcoin exposure in traditional equity markets.
That's right. They offer investors a way to gain access to the asset class without directly holding the coin or an ETF.
Let's start with the valuation side, which primarily affects MicroStrategy, MSTR. The challenge for them is that these names often trade as if they offer leveraged exposure to Bitcoin.
Right. With Bitcoin down from its high point and overall risk appetite fading, investors are less inclined to reward these companies with a premium valuation simply based on their BTC exposure.
MicroStrategy is the clearest example of this proxy trade. Its equity price is highly correlated with Bitcoin because of its extensive BTC treasury holdings.
It is. Investors often assign a premium to MSTR stock over the calculated value of its actual Bitcoin holdings plus its software business. They see it as a leveraged way to play Bitcoin's upside.
So when Bitcoin is pulling back and IBIT is seeing outflows, investors quickly reevaluate whether MSTR deserves that sometimes aggressive premium.
And that premium tends to compress rapidly during periods of market stress. This means MSTR can actually drop faster than Bitcoin itself, fulfilling that leveraged exposure profile in the downside.
Now let's look at the miners, Marathon Digital, MARA, and Riot Platforms, RIOT. Their challenge isn't just valuation, it's operational economics.
Yes. For miners, sustained lower prices increase operational difficulty. This leads to margin pressure if the price doesn't recover.
This is a fixed cost nightmare for them.
It really is. Companies like MRA and Riot rely on a favorable ratio between the price of Bitcoin and their operating costs.
Which are primarily massive electricity consumption and the depreciation of their specialized, expensive mining hardware.
Exactly. When Bitcoin's price declines, their revenue per mined coin drops instantly. However, their high fixed costs for energy contracts, facility maintenance, and interest payments on financed equipment, those remain constant.
Essentially, the cost structure is sticky, but the revenue is volatile.
Precisely. The immediate result of lower prices is a harsh squeeze on their profit margins. This margin compression makes investors wary of maintaining positions in these high fixed cost businesses, especially in a cooling risk environment.
And if the price drops close to or below their estimated break-even cost for some of their older or less efficient mining fleets,
then the possibility of cash flow problems or further debt servicing difficulties becomes immediate. This risk makes the miners high beta proxies for Bitcoin's weakness.
So the record IBIT outflow serves as a catalyst for de-risking positions across the entire ecosystem. And MSTR, Mara, and Riot are particularly exposed because of their extreme price sensitivity.
Investors view them as ways to multiply the movement in Bitcoin both up and down. When the directional move is down and sentiment is negative due to large redemptions, these stocks generally see outflows faster than Bitcoin itself, as investors liquidate the leveraged exposure first.
That dynamic really reinforces why they are identified as specific losers in this particular market flow event.
What we have analyzed today really shows a chain reaction where a large single-day outflow instantly repriced different categories of assets.
It demonstrates the rapid flow of capital toward perceived safety and tactical positioning. The swift reaction out of IBIT and into gold or inverse products illustrates just how sensitive these markets are to major flow events.
For you, the key takeaway is the speed and the specificity of the asset rotation. Money moved out of centralized crypto vehicles and into gold and shorting products.
While simultaneously seeking relative strength in other distinct parts of the crypto market.
Exactly. This is not a simple, uniform exit. It is a complex recalibration. It involves de-risking to gold like GLB and IAU, tactical shorting with BTI, and internal rotation for alpha with BSOL and GSOL.
Understanding these different destinations provides a much clearer picture of investor psychology during periods of stress.
It does.
And considering the market's immediate pivot toward altcoin ETFs like BSOL and GSOL, following the pressure on Bitcoin ETFs like IBIT, the question for further thought is whether this flow indicates a short-term tactical maneuver or if it suggests a longer-term reevaluation of where growth and yield opportunities lie within the digital asset space.
That's the key question.
Is this rotation a temporary hedge against BTC weakness, or is it a signal that, for some investors, the primary growth story has moved beyond Bitcoin?
And that distinction is key for future strategy. A short-term tactical maneuver would imply that once Bitcoin stabilizes, capital will flow back out of BSL and GSL.
But a long-term reevaluation.
That would suggest that the market is now permanently assigning a higher growth premium to assets with specialized ecosystems or superior yield potential. It would make this event a potential waypoint in the evolution of digital asset portfolio allocation.
So that's the challenge for portfolio managers right now, deciding if they are betting on Bitcoin's eventual recovery or betting on the permanent rise of platform utility over pure value storage.
That's the big question they're grappling with.
Thank you for joining us for this analysis of capital flows.
Please remember that the content discussed here is for informational purposes only. This is not financial advice, nor is it a recommendation to buy or sell any security mentioned. The information presented is purely the opinion of the author of the material we have reviewed. Thank you for listening.